Hello and welcome to this podcast. This podcast is part of a series in which we examine the gross income definition. In this podcast, we're looking at the meaning of received or accrued. An amount should be included in gross income when it is received or accrued to the taxpayer. In CIR versus Delphos, the court clarified that the amount must only be included once, and it's at the earlier of receipt or accrual. This was tested in SIR versus Silverglen Investments when the receipt and the accrual happened in 2 different years, and it would have in fact been better from SARS's perspective to include it at the later of the two, because in between the 2 events there had been changes to the tax legislation. The court said it's not up to SARS to choose when to include the amount, it must be included at the earlier of receipt or accrual. There's a question about what received or accrued means in the context of fraudulent transactions and theft. In MP Finance Group versus the Commissioner for SARS, MP Finance Group was a pyramid scheme or a Ponzi scheme. They were collecting money from investors under the pretext that they were investing it with MP Finance Group who would make a return on the investment. But in fact, MP Finance Group was treating the money as their own and was unable to repay the investors. The pyramid scheme fell apart. The question then arose, should MP Finance Group recognize any amounts as gross income when they'd collected it fraudulently? And the court said in that example, there is a willing giver who's giving it to the taxpayer. And if that's the case, and if the taxpayer is treating it as if it were their income, then that amount has been received by the taxpayer. Now in contrast, in Cott versus G, Cott is the Commissioner for Taxes in Zimbabwe, then Rhodesia. G was an employee of the government, and he had access to government funds. And over time, he siphoned off some of that money for himself, and he spent it, and it was subsequently uncovered that he had been stealing money. The question was then, should G recognize gross income since he had taken this money? And the court said in that example, there was no willing giver of the money. He had stolen it from the government without their consent, and that meant that nothing had been received by or accrued to him. And finally, in CIR versus Delagoa Bay Cigarette Company, the question of the legality of the transaction in which the income arose was tested. Delagoa Bay Cigarette Company was running a lottery, and part of the purchase price of a pack of cigarettes entitled you to entrance in their lottery. They recognized a portion of the selling price as gross income, and a portion, they said, was for the lottery. It was subsequently decided that that lottery was illegal, and Delagoa Bay Cigarette Company said that only the portion of the income that related to the selling of the cigarettes should be included as gross income, since the other portion was illegal and should be then excluded from their gross income. The court said whether the transaction in which the income arose was legal or illegal was not a determining factor in whether the taxpayer had received an amount. The only thing that mattered was there a willing giver and a willing recipient? And in that case, there was. So now we need to go a little bit further into what does received by or accrued to mean, and we'll start with received by. If an amount has been received, and it's been received before it has accrued, then whether or not it has accrued has no bearing on whether it represents gross income or not. If it's been received, it should be included as long as it is for the taxpayer's own benefit, as long as it's their money to do with whatever they want. Now, there are 2 cases that stand on either side of the line of the taxpayer's benefit. In Geldenhuys versus CIR, Mrs. Geldenhuys was the widow of Mr. Geldenhuys, who had been a farmer, and he had left a flock of sheep. He had divided the flock in terms of use and ownership, and he had given the use of the flock of sheep to his widow, and he had given the ultimate ownership in the flock of sheep to his children. So Mrs. Geldenhuys was entitled to use the sheep, presumably to farm for wool, but the ultimate ownership of the sheep rested with her children. Mrs. Geldenhuys then sold the flock of sheep, received the selling price, and presumably passed that selling price on to her children. The question was whether Mrs. Geldenhuys should pay tax on that amount. And the court decided that although she had received it in the sense that it had gone into her bank account, at no stage had she received it for her own benefit. Because she wasn't the owner of the sheep, the money wasn't hers to do with whatever she wanted. She had to pass it on to her children. Now contrast that with CIR versus the Witwatersrand Association of Racing Clubs. The Witwatersrand Association of Racing Clubs decided that they were going to hold a race day and that it was going to be a charity race day. So they would give whatever proceeds they made on the race day to a charity. They duly held the race day, collected the takings at the door, and when all was said and done, they paid that on to a charity. And they argued that they had no gross income because the event had been organized with the intention to give the money to someone else. And the court in that instance said that there are two separate transactions. The first was Witwatersrand Association of Racing Clubs receiving the money. And when they received it, it really was theirs. They could do with it whatever they wanted to. What they in fact did was give it to a charity. But that was a second transaction. It was their money and they were free to make that decision. Different from Geldenhuys, who at no point had any choice over what to do with the money. So the amount must be received for the taxpayer's benefit, means that the taxpayer must be able to do with it whatever they choose. Now there's a question about what about amounts that are received but may be given back to the person giving the money. And again, two cases that contrast what that might mean. In Pyatt versus CIR, the question of amounts that are received and might be refundable was examined. Pyatt's is a biscuit company, and they were selling biscuits in tins, and they wanted to ensure that the tins were returned to them. So what they did was they said to customers, we will refund you a portion of the purchase price, the sales price, if you bring the tin back to us. And they were taking the selling price, recognizing a portion in revenue, and transferring a portion to a reserve, that reserve being ready to repay the customers when they brought the tins back. They argued that only the amount net of the potential refund was gross income. The rest had not been received for their own benefit. The court said that that was incorrect. At the date of the sale, all of the money was received for Pyatt's benefit. They received that money and they could do with it whatever they chose. It might have been prudent of them to put that into a reserve, but the fact remained that at the date of the sale, they had no further obligation to the purchaser. If and when a refund arose, that was a second transaction that was triggered by the return of the tins. But until those tins had been returned, there was no obligation to repay that refund. So 100% of the selling price had to be recognized by Pyatt in their gross income. When the tin was returned, then they would repay the deposit, and that may bring about other tax consequences, but it didn't change the original amount received. Now, in contrast to that, in CIR versus Jen & Co., the court said that when a loan is received by the borrower, that is not gross income for the borrower, because at the date that they receive the loan, they also incur an obligation to return a similar amount of money to the lender. That is not gross income. So what about scenarios where there is a refundable deposit? You enter into a transaction, you pay a deposit. If that transaction is cancelled, the deposit is returned. Well, the only way for the seller in that transaction to show that that amount is not received for their own benefit is to put it in a separate trust account, separate from the rest of their money, and an account which they are not entitled to access and do with whatever they choose. If they're not able to do with it whatever they choose, then that amount is not received for their own benefit. But if they can, in the interim, do whatever they wish with the money, then the fact that they may have to return it at some other point does not mean that it hasn't been received. An amount is included in gross income at the earlier of receipt or accrual. So if the amount hasn't yet been received, we need to ask the question, has it accrued to the taxpayer? And accrued means slightly different things in tax than it does potentially in accounting. There's been some development in this through the case law, and in Latergan versus CIR, the court said that accrued means entitled, i.e. the taxpayer has performed their side of the contract. Remember again, if they've received the money, then whether it is accrued to them does not determine whether it's gross income or not, so we are assuming that they haven't yet received the money. In CIR versus People's Stores were selling to their customers on interest-free credit. And they argued that at year-end, they were not entitled to the money because they had promised their customers interest-free credit for a period, and that period had not yet elapsed. They couldn't go knock on the door and demand their money, and so they argued that money had not accrued to them yet. The court said that it's not about whether they're entitled to collect the money, it's whether they're entitled to payment. And at that point that People's Stores made the sale, there was nothing further they had to do in the agreement. They were entitled. The court also said at that point that if we're talking about entitled to payment, then the amount that we must value must surely be the present value. And that decision didn't go down so well, so subsequently the gross income definition was amended, and at the end of the gross income definition it now says that where an amount accrues to the taxpayer, it is deemed to accrue at its face value, even though in reality, in the absence of that provision, we would include the present value. So there's no present valuing of gross income anymore. There's a specific proviso that says it's at face value. Going back a step, in Moy versus SIR, Moy was employed at a mine, and as part of his employment, he received options to buy shares. He received them in year one, but he wasn't entitled to buy the shares until the point that the mine was completed and on stream. And SARS argued that because he had received the options in year one, and all that we were waiting to do was for the time to elapse when he could exercise the options, that the gross income should be recognized in year one. The court ruled that that wasn't correct, because at year one, Moy had not completed everything on his side of the contract. He still needed to get the mine on stream and up and running. And so the court said that the taxpayer must be unconditionally entitled before they have gross income. So at the point that they recognize gross income, it must be because they have nothing more to do on their side of the contract. Mr. Moy still had to complete the mine before he could exercise his options. The fact that the taxpayer must be unconditionally entitled to the amount does not mean that the amount itself must be certain. If the amount is uncertain, but it is possible to make an estimate, then it's acceptable to recognize that estimate as gross income and to true it up in later years if it's not 100% accurate. However, if the amount is unquantifiable, then recognition is deferred until the point that it becomes quantifiable. And Section 24M specifically legislates that in relation to the purchase and sale of assets. It says when an amount cannot be quantified, then the tax effects are delayed until the point that it is quantifiable. So that's it for received and accrued. In the next podcast, we're going to look at what it means to have income of a capital nature or not of a capital nature.